We have with us Ajit Dayal, founder of Quantum Advisors. Thank you, sir, for joining us today. How was your experience at Moneycontrol's Mutual Fund Summit?
Excellent. My first conference I've attended in years. Most conferences don't call me to speak, so I was absolutely honored to come and talk and share my thoughts and views on what I think about the industry and the markets.
So I'm going to ask you some brief questions. Let's get started.
Yes, of course.
Okay. Quality or value? What's your style of investing?
So we are value investors, but we look at quality in terms of governance. So we started something in 1996 called the Integrity Screen, and that looks for qualities of management that are good. Otherwise, if you have good valuation but poor quality of management, you will not be in the portfolio. So both, but valuations matter.
What's your mood for the market right now? How are you seeing it?
So I think there's two things. One is that India is on a phenomenal bull run. There's no doubt about that. There'll be economic growth. With economic growth, there'll be stock market returns. Having said that, there are little parts of the market that have got bubbles in it, and the bubbles are in small cap, in mid cap, and in certain sectors. So you have these thematic funds that are being launched. We think that's dangerous because it's going to extend the PE ratio and the valuation of that sector, and these things never turn out good. They always crash.
So what would be your top choice? Large cap, mid cap, small cap? I'm guessing large cap.
So even in large cap, there can be bubbles, but what we look at, say, is valuation. I've said if I had to choose a market cap, it'll be in large cap of the three, if I had to choose.
So you're talking about valuation and concerns. What are three red flags that you can't ignore in companies that you're evaluating as investments?
So one of them, of course, like I mentioned, is how the management treat minority shareholders. So if there's a red flag on that, we don't care what the valuation can be very attractive, but we're not going to buy it. The other flag is going to be if a company is trying to grow very rapidly and take on too much debt. So we don't like companies that have got too much debt or plan to take on too much debt. And the third part that we don't like is when companies, particularly financial companies, when financial companies try to gain market share and grow rapidly to get market share. We don't like that because that means they're taking on risks that could be much more than what they planned. So we always look at risk and then at the return.
Okay. And if you had to say, apart from like stock market, mutual funds, where would you put your money? Where do you like to put your money?
Gold. I think gold is a great place to invest. I want to point this out that since 1971, August 15th, that's when President Nixon took the US dollar off the gold standard. So 1 ounce of gold was $38 in 1971. Today, that same ounce of gold is $2,500, which means that the US dollar, which is a strong currency, has lost 98% of its value against gold since 1971. And the Indian rupee has lost 99.5% of its value against gold since 1971. So gold.
Okay, quite interesting even. And lastly, I want to ask you, what would be your top tip to people who are looking at companies to invest in? What would be your way to go forward? How should they go forward?
So I won't call it a tip, but we just heard Grandmaster Viswanathan Anand talk about chess. And I didn't get a chance to ask a question, but that will be the way that when you make a move in chess, you always think about what can go wrong, the risk of making the wrong move. And I would urge investors not to just look at the return, but to understand the risk of making the wrong allocation and the wrong investment. And then they'll end up doing the sensible thing. And think long term. Think very, very long term. No punting, no one-year track records, none of that stuff. Think long term.
Okay. Thank you so much, sir. That was quite insightful. Thank you so much.